All right, we're throwing the standard agenda out the window today. We are diving straight into a massive, invisible mystery that's literally rewriting tech economics and, yeah, actively draining your wallet as we speak. We're calling this whole phenomenon Ram-mageddon. In this explainer, we're decoding the memory market meltdown by looking at the hard data and the deep structural fractures that got us here.
Take a look at this, what we're calling the $1,300 symptom. If you track recent price adjustments from Apple, iPads are up $100 or $200, MacBooks are up too, but look right down there at that bottom row, the top-tier Mac Studio. That price just jumped from $39.99 to an eye-watering $5,299. I mean, that's a sudden, massive $1,300 spike. This isn't just your standard inflation or some minor margin tweak. This aggressive climb, it's the ultimate consumer symptom of a massive, hidden fracture in the supply chain.
And just to prove how totally unprecedented this is, Apple themselves perfectly summed up the stakes. They said, "We have never seen component prices rise this much in a short period." Think about that. When a company with literally the most formidable, heavily optimized supply chain on planet Earth says they've never seen anything like this, yeah, we need to pay attention. So it begs the big question for our explainer today: what exactly broke the global semiconductor pricing equilibrium?
Let's kick things off with Part 1, the 2023 Semiconductor Supply Chain Collapse.
Okay, so memory fabrication is hyper-capital intensive. In a typical fab, a staggering 75% of costs are completely fixed. We're talking multi-billion-dollar clean rooms and massive depreciation that just keeps piling up, whether those conveyor belts are moving or not. Now, remember that post-pandemic slump? Buyers absolutely ruthlessly squeezed prices down, way below the actual cost of manufacturing. But fabs couldn't just stop. They had to keep the lines running just to grab whatever tiny bit of cash they could to offset that massive overhead. And the result? Well, Micron recorded a negative 9.1% gross margin and a devastating $5.8 billion net loss in 2023 alone. Ouch.
So this triggers a massive chain reaction that we're calling the delayed bell. Back in 2023, the squeeze forced rock-bottom pricing. To survive those billions in losses we just talked about, suppliers went into the halt through 2023 and 2024. They totally froze capital expenditures. Expansion? Canceled. But then, bam, 2024 hits and the AI catalyst arrives. Demand exploded literally overnight. And since you can't just build a new fab in a weekend, it takes years. Leading into 2026, we are staring down the barrel of a structural supply void. Basically, the shortage we're feeling right now, it was structurally guaranteed by those aggressive buyer tactics back in 2023.
Which brings us to Part 2, AI's massive shockwave.
Now that staggering 1 million X figure, that's the estimated explosion in global computing demand over a mere 24-month period, driven pretty much entirely by AI data centers. I mean, the demand curve literally just goes vertical. Looking at the immediate price reactions, specific memory spot pricing surged 6 times over the trailing 12 months. And TrendForce, they're projecting nearly a 100% price surge by early 2026. The market is operating completely beyond traditional supply and demand right now.
Moving right along to Section 3, the physics of memory production.
So why can't they just print more chips? Well, the core physical bottleneck really comes down to architecture. Think of standard DRAM, the stuff in your typical laptop, like a single-story house. It's a wide, flat layout, perfectly designed for standard data processing. But AI? AI doesn't want a single-story house. It needs high-bandwidth memory, or HBM, to feed massive datasets instantly into its accelerators. So HBM is built more like a high-rise apartment. It physically stacks multiple layers straight up, connecting them with microscopic elevator shafts called through-silicon vias. It's an engineering marvel, for sure, but it is incredibly tough to build.
When you compare these metrics side by side, you can immediately see why HBM is such a nightmare to produce. Check out the yield characteristics right at the bottom. Standard DDR5 is just a single chip. It's stable, predictable. But HBM, that requires 8 to 12 layers of incredibly fragile stacking. If just one microscopic layer in that tall apartment building goes bad, the entire bonded stack goes straight into the trash. Because of this extreme process complexity, the overall yield of usable chips actually making it out of the factory is drastically lower.
And here's where it becomes a huge, zero-sum problem for the rest of us. Because producing HBM is so wildly inefficient, running just one line of AI memory completely cannibalizes 3 general DDR5 lines. Literally, 3 standard memory conveyor belts are sacrificed to make a single belt of HBM. It is a brutal cleanroom reality. Every single highly profitable AI memory order that gets fulfilled is directly starving the consumer and server markets of standard memory. There's just not enough factory space for both.
This leads us perfectly into Part 4, the complete reversal of market power.
Remember how in 2023 the buyers held all the cards, squeezing suppliers down to that brutal negative 9.1% margin? Well, thanks to the supply void and this massive AI boom we're looking at, the pendulum hasn't just swung, it's completely inverted. Suppliers are actively rationing their output now. They're prioritizing only the ultra-lucrative AI segments and snagging astronomical margins of up to 84.9%. The suppliers are entirely dictating the terms now, and general consumer tech? Yeah, it's been shoved straight to the back of the line.
The whole fundamental economic model of memory has permanently flipped. We're totally out of the commodity era. You know, the old days where components were cheap, standardized, bought on quick spot contracts, and suppliers just ate all the financial risk. Not anymore. We are now firmly planted in the strategic era. Memory is now custom-engineered infrastructure. If you want it, you're signing a multi-year long-term agreement, you are paying cash up front just to reserve your spot on the factory line, and the financial risk? That's explicitly shared between the buyer and the supplier.
To really grasp how intense this new strategic era is, just look at the anatomy of these new long-term agreements, or LTAs. Micron literally locked away $22 billion in upfront deposits just to secure commitments for 2026 out to 2030. Buyers are essentially pre-funding the factories. And to balance out that risk, they're using a floor to guarantee the fabs a minimum price so they don't go bust during a downturn, and a ceiling to protect the buyers from infinite price hikes during a boom like the one we're in right now. Memory is becoming a closed club. If you don't help build a clean room up front, you just don't get the chips. Simple as that.
Finally, let's wrap up with Section 5, downstream impact and the new economic rules.
We're essentially staring at a ticking time bomb for retail prices here. Now, I know iPhone prices have stayed somewhat flat lately, but honestly, that's just a short-term exception. Looking ahead, JP Morgan projects that memory and storage will chew up over 45% of an iPhone's total material cost by 2027. Think about that. Once a single component eats up nearly half the cost of the device, the manufacturer simply can't absorb that hit anymore. Severe consumer price hikes in mobile aren't just likely, they are mathematically inevitable.
So, bringing this all together, here are the 3 major takeaways you really need to pull from this explainer. Number 1, this inflation, it's structural. It's driven by literal physics and a massive supply void, and it is not going to self-correct anytime soon. Number 2, the old playbook of ruthlessly squeezing suppliers is dead. If you want to survive, you need long-term agreements. And number 3, supply chain management isn't just about cutting costs anymore. It is the absolute core competency you need for corporate survival in the AI era.
I want to leave you with one really provocative question to chew on. In this new era, where memory is essentially shared infrastructure, who will truly determine the price of your next smartphone? Will it be the tech giants who design them, or the semiconductor factories demanding you co-fund their billion-dollar clean rooms? Just something to think about the next time you see a price tag jump. Thanks so much for joining me for this explainer. Keep learning, and I'll catch you next time.